If you have ever been told that nobody can beat the market, you have been told something that is almost true. Almost. There is one exception, and it is documented. One fund did it for 30 years, starting in 1988. It compounded at a rate that should not exist, and then it stopped taking outside money entirely. The man who built it was not a trader. He was a geometer. He had run a university mathematics department, and before that, he had broken codes for the American government. He was 40 years old when he left academia for a strip mall on Long Island, and by most accounts, he had very little idea what he was doing at first. So how does a mathematician who had never traded anything end up with the best track record in the history of markets? And why did he shut the door on new investors? In the next half hour, I want to show you what he actually built, why the number you have heard is smaller than it sounds, and what part of it you can genuinely use. James Harris-Simons was born in 1938. He was one of those children who does mathematics the way other children do football, constantly, without being asked and without any particular sense that it was work. He went through university fast, took a doctorate in mathematics, and by his middle 20s, he was doing the kind of work that gets a person a permanent job for life. In academic terms, he had already arrived. Pure mathematics is a strange career, and I want you to feel how strange, because it shapes everything he did afterwards. You spend years on a problem that perhaps 11 people on Earth understand, and the reward is that those 11 people agree you were right. Simons was good at it. Genuinely good, not merely competent. The work he did in differential geometry is still taught, and we will come back to it because it matters later. But between 1964 and 1968, he did something else. He joined the research staff of the Institute for Defense Analysis in its Communications Research Division. That is a careful way of saying he was a codebreaker. The division did cryptographic work for the National Security Agency, and Simons split his time between attacking codes and his own mathematics. This is the part of the story people skip, and it is the part that explains everything else. Code breaking is not about being clever about the message, it is about the pattern underneath it. A cipher looks like noise. It is meant to. The whole craft is to sit with something that looks like noise and find a small statistical regularity that says, this is not noise, this is structure. You do not need to know what the message says. You do not need a theory of the sender. You need a signal that is slightly stronger than chance, and then you need to trust it. Hold that sentence because in about 20 minutes, I am going to hand it back to you, and it will be the entire description of how the fund worked. He also learned something else at the Institute, which was how to run a room full of extremely intelligent, extremely difficult people who do not respond well to being managed. That skill turns out to be rarer than the mathematics. Plenty of people can find a signal. Very few can build an organization where 30 people find signals and none of them leave. By his late 20s, Simons had a secure position, real standing in his field, and classified work that mattered. On paper, a finished career. He was about to lose it. Not through scandal and not through failure. He lost it by writing something down and putting his name on it, which is a thing he did more than once in his life. The year was 1968, and the subject was Vietnam. In 1967, Simons wrote a letter to the editor of the New York Times. It argued in public and under his own name against the war his employer was helping to prosecute. Then he spoke to a reporter from Newsweek and said something more direct, that he intended to stop working on Defense Department tasks until the war was over. He was dismissed. That is the plain version, and it is the accurate one. The Institute let him go in 1968 over his public opposition to the war. I want to be careful here because it would be easy to turn this into a hero story, and the record does not need the decoration. He was a young man with a secure job who said a thing he believed in a way that made it impossible for his employer to keep him, and it cost him the job. What is interesting is not the courage. It is what it tells you about how he handled a position he was confident in. He did not hedge it. He stated it and accepted the consequence. That is an unusual temperament, and it is the same temperament that later let him run a fund on signals nobody could explain in words, through years when the explanation would have been comforting. Most people cannot hold a position they cannot justify out loud. Simons could hold a position he could justify only in numbers, which is a different and much harder thing. So at 30 years old, he was out of classified work and back in universities, and the next 10 years look, from the outside, like a completely ordinary academic career. Teaching, papers, committees, the usual furniture of a professor's life. They were not ordinary at all. They were the years he learned the second half of the job, and without them, the fund would almost certainly not have worked, however good the mathematics behind it had been. Because a mathematics department is not a laboratory. It is a collection of individually brilliant people with no natural reason to cooperate, no shared project, and strong opinions about each other. Running one well is a management problem disguised as an intellectual one, and Simons, by every account, ran one extremely well. He was given the chair of the mathematics department at Stony Brook on Long Island, and he held it from 1968 to 1978. 10 years. A full decade of recruiting, arguing, defending budgets, and persuading brilliant people to come to a state university on Long Island rather than somewhere with a more famous name. He was, in other words, learning to hire. The Stony Brook decade is where the mathematics that carries his name was done. With the geometer Xing-Shin Chern, he co-developed what is now called Chern-Simons theory. I am not going to pretend to explain it properly in a sentence, and you should be suspicious of anyone who offers to. But I can tell you what kind of thing it is, because the shape of it matters more here than the content. It is a way of describing properties of a space that do not change when you bend or stretch it. Not the measurements, the things that survive the deformation. That idea escaped mathematics entirely. Physicists picked it up and it became central to parts of theoretical physics that had nothing to do with the problem Chern and Simons were solving, which is the ordinary miracle of pure mathematics. Somebody answers a question nobody asked, and 30 years later, it turns out to describe how the world works. For our purposes, the point is narrower. Simons was not a competent mathematician who went into finance. He was a first-rank one who left at the height of his powers. That distinction matters because of what it says about the decision. This was not a man escaping a career that had stalled. He walked away from one that was working. Why? The honest answer is money, and he said so. He had been trading a little on the side, with some success, and he found the problem interesting. There is a version of this story where that sounds shabby. I do not think it is. A market is, mathematically, a very rich object, enormous, noisy, and generating data continuously. If you spent 4 years looking for structure inside things that appeared to be noise, a market is not a betrayal of your training. It is the largest available instance of your training. So in 1978, at the age of 40, Simons left the university and founded a firm called Monemetrics in a strip mall on Long Island. A strip mall next to a pizza place by most tellings. This is the entire glamour of the origin, and I think it is worth dwelling on for a moment. Because the fun this became is now spoken about the way people speak, about a magic trick. And it started with a middle-aged professor renting a small office near a shopping parade. The firm was later renamed Renaissance Technologies, but that came afterwards, and so did everything else. What happened first was several years of not really working. That is the part of the story that gets cut, and it is the part you should actually pay attention to. Here is what did not happen. Simons did not arrive with the mathematical theory of markets, apply it, and get rich. Nothing in the record supports that version, and he never claimed it. What he did at first was trade currencies and commodities largely on judgment, the way everybody else did. And it worked, sometimes in the way that judgment works, unevenly and stressfully. He has described being unable to sleep, watching positions, feeling the swings personally, which is exactly what a discretionary trader's life is, and exactly what he was temperamentally unsuited to. The founding insight, when it came, was not about markets at all. It was about him. He decided he did not want to have opinions because his opinions made him miserable and were not reliably better than anyone else's. So the question became, could you take the human out of it entirely? Not assist the human, Replace the human with a system that decides and a person who only maintains the system. That is a much stranger idea in 1978 than it sounds now. There was no easy data. There were no cheap computers. There was no industry of people doing this to copy from. The data problem in particular was brutal. If you want to test whether a pattern holds, you need decades of prices, clean, aligned, and corrected for every split and change of contract. Nobody sold that. So Renaissance built it. People were sent to find old records, prices were typed in by hand from paper, errors were hunted individually. According to Gregory Zuckerman's account of the firm, this data work consumed years and was treated as a first-class activity rather than a chore handed to juniors. I want to underline that because it is the least glamorous fact in this episode, and it is probably the most important one. The edge started as data hygiene, not a formula, not a genius insight, a refusal to test ideas against numbers that might be slightly wrong, and the patience to spend years making sure they were not. Because here is the trap. If your data is dirty, a bad idea can look good, and a good idea can look bad, and you cannot tell which mistake you are making. You will then spend a decade tuning a system that is fitting your errors. Every serious quantitative operation that has failed at least partly here. Simons brought in people who could do this, not finance people, mathematicians, statisticians, and eventually people who had worked on machine translation and speech recognition, which is a stranger hiring choice than it appears. And it is the next thing I want to explain because it is where the whole method actually comes from. Speech recognition in the 1970s and 80s was a field in crisis, and the crisis was philosophical rather than technical. The machines were fine. The idea of what the machines were supposed to be doing was wrong. The obvious way to make a machine understand speech is to teach it language. Give it grammar, give it phonetics, give it rules about how sounds combine into words, and let it reason its way from the sound to the meaning. That approach was tried seriously for years, and it worked poorly. Human speech is too irregular. Every rule has exceptions, and the exceptions have exceptions. The approach that won was to give up on understanding. Take enormous quantities of recorded speech, count what tends to follow what, and build a statistical model with no idea what any word means. It felt like cheating. It was not elegant, it explained nothing, and it beat every system built by people who actually knew about language. Now put a market in place of the speech. You have the same structure, everybody trying to model it from theory, from what a company is worth, from what an economy is doing. And an alternative, ignore meaning entirely. Take enormous quantities of price history, count what tends to follow what, and act on regularities you cannot explain. This is the same move. It is the code breaker's move too, the one I asked you to hold on to. Do not model the sender. Find the structure and trust it. The people Simons hired had made that move before in another field and had been proved right. They did not need persuading that an unexplainable signal could be real. And that is a genuine cultural advantage, not just a technical one. Most finance people cannot act on something they cannot narrate. It feels irresponsible. A former speech researcher has no such problem. They spent their career watching the narratable approach lose to the unnarratable one. Now, I have to be honest about the limits of what is known here, because this is exactly where documentaries start inventing things. Nobody outside the firm knows what its signals are, not in outline, not in category, not in any useful sense. Renaissance is famously, aggressively private and always has been. So anyone who tells you the strategy is describing a guess, I am not going to add another guess to that pile. What can be said is structural, and it is enough. Many small signals, each weak, each individually unimpressive, combined and traded at scale and at speed. In 1988, Simons and his early partner, James Axe, launched a fund. They called it Medallion, after mathematics prizes the two of them had won. It is a slightly self-satisfied name for what became the most closely studied track record in the industry. It is also, I think, an honest one. The prizes were the qualification, and it very nearly died immediately. The early period went badly enough that the fund's survival was genuinely in question. This is documented, and it is not a dramatic flourish. The machine did not simply switch on and work. What followed is the decision the whole story turns on. Faced with a system losing money, they did not add human judgment back in. They rebuilt the system. Think about how unusual that is. The obvious response to an automated strategy losing money is to override it. Every instinct says a person should step in. They went the other way. The mathematician Elwin Berlekamp took a leading role in the reconstruction, and the fund was rebuilt around shorter horizon trading and tighter statistics. Zuckerman's account describes serious internal disagreement in this period. I would treat the detail of who said what as book level rather than settled, but the outcome is not in dispute. The rebuilt fund worked, and then it kept working, which is the part that is actually hard to believe. Because strategies decay. That is the ordinary life cycle. Somebody finds an inefficiency, trades it, other people notice, they trade it too, and it closes. Usually within a few years. A fund that beats the market for 3 years is lucky or early. A fund that does it for 30 has to be finding new signals continuously, as fast as the old ones die. That is the real achievement, and almost nobody states it correctly. It was never one discovery. It was a factory for discoveries, and the factory outlived every individual product. Which brings us to the numbers, and I want to handle them carefully because they are the most misquoted figures in modern finance, including by people who are not trying to mislead you. The numbers are genuinely confusing for a reason I can explain in about 90 seconds. So, let us do that properly. Between 1988 and 2018, the Medallion Fund generated more than $100 billion in trading profits. That figure is widely reported and is the one to anchor on. Over that same period, its annualized return, after fees, was approximately 39%. Let me put that in perspective, because 39% is a number people nod at without feeling. A broad stock index over a long period returns something in the region of 10. Before fees, the figure is usually quoted as around 2/3. I want to flag that one. The gross number is reconstructed by outsiders from the net returns in the reported fee schedule. Renaissance never published it. So treat the net figure as the reported one and the gross as an estimate. That distinction is exactly the kind of thing that gets flattened when a number travels. It is also reported to have had just one losing year across that period. I say reported deliberately. The underlying series is not public, and I am not going to state it as though I had audited it. Now, the gap between roughly 2/3 and 39. Where did the rest go? Fees. The fund is reported to have charged something in the order of 5% of assets and 44% of profits. Those are extraordinary terms, and I want you to hear how extraordinary. A conventional hedge fund charged 2% of assets and 20% of profits and was considered expensive for doing so. This is more than double that on both halves. And here is the thing I want you to actually take away from this section. Because it is a general lesson wearing a specific costume, the gap between the gross and the net is not a footnote. It is roughly 1/3 of the return, and it went to somebody who was not the investor. A strategy is not a return. A strategy minus its costs is a return. This is true of the greatest track record in history, and it is true of whatever you are looking at. Now hold on to the second half of that, because it leads directly into the strangest decision in the whole story. If the fund charged those fees and still delivered 39% net, it was the best investment available anywhere on earth by an enormous margin. Demand for it would have been effectively unlimited. Any amount of money would have queued up. The firm could have named almost any terms. They closed it instead. Medallion stopped taking outside money. Not because of a scandal, not because of a bad year, and not because anybody made them. Over time, it was wound down to employee capital, and it has run essentially as an internal fund since. I am not going to give you a date because the sources disagree about which tranche closed when, and a confident wrong year is worse than an honest vague one. The reason it closed, though, is not vague at all, and it is the single most useful idea in this episode. It is called capacity, and almost nobody outside professional investing thinks about it. Here is the problem. A strategy that exploits a small, brief inefficiency can only absorb so much money before the act of trading destroys the very thing it is trading. If a signal says an instrument is slightly mispriced and you buy a modest amount, you capture the mispricing. If you buy an enormous amount, you move the price yourself and the mispricing disappears. Your own buying is the thing that closes the gap. Past a certain size, you are not exploiting the inefficiency. You are the inefficiency. So every strategy has a ceiling. Some ceilings are very high. A strategy of holding a broad index has an almost unlimited one. A fast, small edge strategy has a low one. Medallion's ceiling appears to be low relative to how much money wanted in, which leaves a choice: take the money and let the returns fall, or refuse the money and keep the returns. Almost every fund in history has taken the money. The fees are charged on assets, so more assets means more revenue, even as performance degrades. It is not even dishonest, exactly. It is just that the interests of the manager and the interests of the investor point in opposite directions at that fork, and the manager decides. Renaissance took the other road from Medallion. They capped it and kept it, which meant the people who had built the thing were the people who owned its returns. And that tells you they believed the ceiling was real? Nobody turns away that much money to make a point. It also tells you something about every fund that did not close, which is a thought worth sitting with. So why has nobody replicated it? Quantitative investing is now an enormous industry. The mathematics is taught, the computing is cheap and universally available, the data is bought rather than typed in from paper. Every single input Simons had to invent from nothing is now something you can buy on a subscription. And in all the years since, with all of that available, nothing with that record has appeared. That is a fact worth explaining rather than admiring. Part of the answer is simply that the early edge is gone. Some of what Renaissance found in the 80s and 90s was available because almost nobody was looking. But the more interesting part of the answer is organizational, and it goes back to that mathematics department on Long Island. Renaissance hired scientists rather than financiers, more or less as a standing policy. People from physics, from statistics, from computational linguistics, from astronomy. People whose entire training was in pulling faint regularities out of very noisy measurements. The stated reasoning is that somebody who has spent a career finding weak signals in noisy data has exactly the skill and no bad habits from finance to unlearn. And crucially, the research was shared internally rather than split into competing teams. One code base, one set of signals, everybody's work feeding the same machine. That sounds obvious, and it is remarkably rare. Most large funds run separate teams who guard their own work because the compensation structure makes them rivals. Renaissance paid people in a way that made the fund's total performance the thing that mattered, so sharing your best idea was not an act of charity against your own interest. That is the piece I would argue is genuinely hard to copy, not the mathematics, the incentive design that makes very clever people cooperate for decades. Anybody can hire a physicist. Building somewhere a physicist will stay for 20 years and hand over their best work while they do is a different problem entirely. And notice that this is the skill Simons spent the 1970s learning in a job that had nothing to do with money. The chair of a mathematics department and the head of a research fund are, structurally, the same job. Recruit brilliant, difficult people, keep them, and get them pointed in one direction. He had 10 years of practice at it before he ever placed a trade. That is not a detail of the biography. That is a large part of the explanation, which leaves the last part of the story, and it is the part he seemed to care most about. Simons gave an enormous amount of money away, and he did it in a specific and unusually coherent direction. He and his wife Marilyn established the Simons Foundation, which became one of the largest private funders of basic scientific research in the United States, not applied research with a product at the end of it. Basic research. Basic research, meaning the kind with no application in view. The kind he had done at Stony Brook, where you answer a question nobody asked and hope somebody needs it in 30 years. He also founded Math for America, which does something narrower and, I think, cleverer. It pays working mathematics and science teachers to stay in public school classrooms, not to train new ones, which is what almost every education program funds. To keep the good ones who are already there by making the job financially survivable and professionally respected enough that leaving stops being the obvious move. That is a very characteristic piece of thinking. The bottleneck is not the supply of enthusiastic beginners, it is retention of experienced people. Fix the leak rather than the intake. It is the same instinct as the fund. Find the part of the system that is actually binding and work on that, rather than on the part that is easiest to be seen working on. Chern-Simons died on the 10th of May, 2024, at the age of 86. The obituaries all led with the returns, which is understandable and slightly beside the point. The returns are the headline. They are not the transferable part, and a story is only worth half an hour if some of it transfers. Because the returns are the part of the story you cannot have. You cannot invest in Medallion. You could not have invested in it for most of its life. That door was deliberately shut. What you can have is the method of thought, and that turns out to be portable in a way the fund never was. A man who was told to stop looking for patterns in secret messages went and looked for them in prices instead, and treated both as the same problem. He was fired once for saying plainly what he thought. He spent 10 years learning to run a room. He spent years cleaning data before he trusted a single conclusion drawn from it. And when the thing he built got so good that the world tried to pour money into it, he closed the door because he understood what the money would do to it. So let me give you the 4 things I think are actually worth carrying out of this. 1. A track record is not evidence you can act on unless you understand the mechanism behind it. What? 39% a year for 30 years is the strongest track record in the industry, and it is still not a reason to do anything because the mechanism is private and the fund is closed. When you see a spectacular record anywhere, the useful question is not, how big is it? It is, do I know why it worked? And is that reason still true? If the answer is no, you are looking at a fact about the past rather than information about the future. Those feel identical and they are not. 2. Capacity is a real constraint and almost nobody mentions it. Every strategy has a size beyond which it stops working because your own trading destroys the edge. A fund that keeps taking money after it has passed that point is selling you a diluted version of what it advertised. So a fund that closes to new money is telling you something true about itself. And a fund that never closes, no matter how much comes in, is also telling you something. That is a question you can actually ask of anything you are shown, and almost nobody does. What is the ceiling on this, and how near to it are we already? If nobody can answer, that is itself the answer. 3. The gap between gross and net is where the story is. Roughly 2/3 became 39. Around 1/3 of the greatest return in history went to costs. If that gap is that large at the very top, it is not smaller further down. Whenever a return is quoted at you, the first question is whether it is before or after everything. That single question does more work than most analysis. 4. The unglamorous part was the edge. Years of cleaning data, a decade of learning to manage difficult people, an incentive structure that made cooperation rational. None of that is a formula, and all of it was necessary. The lesson generalizes past investing, which is why I wanted to end on it. In most fields, the visible skill is not the binding constraint. The boring infrastructure underneath it is. Simons was a great mathematician, but the reason the fund worked was that he was a great head of department first, and he never stopped being one. So, understand the mechanism, ask about capacity, read the net figure, and respect the unglamorous work. 4 things, and none of them require you to buy anything. Next week on Legendary Investors, somebody who is in almost every way the opposite of Chern-Simons. No computers, no team, no institution. One woman operating alone in an era that gave her no formal power at all, who became the richest woman in America and outlived nearly everyone who mocked her. Hetty Green, and the rules she never broke. That is next Tuesday. If this was useful, follow the channel, and I will see you then.